Hello, everyone, and welcome to part one of the Week 1 live chat lecture. What follows are some key points and detailed notes from this week's reading assignments. You can use this information to help guide your study efforts, and as always, let me know anytime you have questions about the course content or procedures. Since this is our first live chat for the course, we will begin by exploring some of the foundational concepts and basic definitions. In the realm of investments, the essential nature is quite straightforward. It's mostly about sacrificing consumption today with the aim of enabling greater consumption in the future. This is the foundational trade-off that underpins all investment decisions, the classic dilemma between immediate gratification and potential future gains. Let's talk about real assets first. These are the tangible resources like property, plant, and equipment, as well as intangible ones like human capital and patents. Real assets are the cornerstone of the economy because they are used to produce goods and services. They represent the physical or direct claims on a company's output and are what ultimately determine the productive capacity and economic wealth of a society. On the other side, we have financial assets. These don't hold the same physical form as real assets. Instead, they represent the claims on the income generated by real assets or the income that those real assets produce. Financial assets come in the form of securities, like stocks and bonds, which are essentially promises to deliver cash flows in the future. So to summarize these basic concepts, while real assets contribute directly to the production of goods and services, financial assets provide the means by which savings are transformed into investments. It's a symbiotic relationship where financial assets depend on the income generated by real assets, and real assets require the financial capital that is acquired through the issuance of financial assets. An important financial concept that often goes unnoticed is this one. Every financial asset, which is essentially an ownership claim, is simultaneously someone else's liability. Therefore, when we examine financial assets in isolation, we might be misled into thinking that they represent net wealth. However, when we look at the economy as a whole and aggregate all of the balance sheets, we notice something profound. All financial assets net out. What does this mean? Well, my claim on a financial asset is offset by someone else's obligation to pay that asset. Hence, in the aggregate sense, these claims do not add up to net wealth. So what does constitute the net wealth of an economy? The answer lies in real assets. These are the resources that actually create value, like land, buildings, machinery, and human ingenuity. It's the real assets that remain when everything else cancels out. They are what's truly owned by the economy without corresponding liabilities. In other words, the actual wealth of an economy doesn't come from the financial instruments we trade, but from the real assets that these instruments are built upon. This distinction is critical when we think about the health and wealth of an economy, especially in the context of investment strategies and financial planning. Next, we take a look into the major classes of financial assets or securities, which represent a significant portion of the investment universe. Starting with debt securities, we're looking at instruments like money market instruments, which can include bank certificates of deposit, treasury bills, and commercial paper. These are typically short-term assets with maturities of less than 1 year and are often used for liquidity management due to their lower risk and higher liquidity. Next, we have bonds, which are longer-term debt instruments issued by corporations and governments. Bonds are a cornerstone of the fixed income market, providing a predictable stream of income through interest payments. Preferred stock is an interesting hybrid, combining features of both debt and equity. Like debt, it typically offers a fixed dividend, and like equity, it represents ownership in a company. However, preferred stock typically does not confer voting rights. Then we have equity securities, with common stock being the most prevalent form. Holding common stock means you have an ownership stake in a company. This gives you a claim on the residual cash flows, which are the earnings after the company has paid all its expenses, including debt payments. This class of security participates directly in the success or failure of a company, with dividends and capital gains as the primary returns. Lastly, we cover derivative securities, complex financial instruments like options, futures, and swaps. The value of these is derived from the performance of other underlying assets such as stocks, bonds, commodities, or market indexes. Derivatives are used for various purposes, including hedging risk, speculation, and leveraging positions in other assets. Each of these asset classes plays a distinct role in investment strategy and portfolio management, offering a range of risk and return characteristics that investors can utilize according to their investment objectives. Let us now direct our discussion toward the subject of corporate governance and corporate ethics. Here we will explore the foundational role that trust plays in the operation of businesses and markets. Trust. It's the bedrock upon which efficient market transactions are built. Without trust, there's a substantial increase in the need for regulations and oversight to manage interactions and transactions, which inevitably introduces additional costs. It is crucial to understand that while laws and regulations are necessary to ensure fairness and accountability, they also come with a price tag. Compliance requires resources, and the costs associated with legal and regulatory frameworks are ultimately borne by businesses and, by extension, consumers. Furthermore, when corporate governance and ethics fail, the consequences extend beyond immediate financial loss. Such failures have historically cost economies billions, even trillions of dollars due to the erosion of public support and confidence in market-based systems. This erosion can lead to a reluctance to invest, a reduction in consumer spending, and increased skepticism towards financial institutions. In essence, we must acknowledge that good corporate governance and robust ethical standards are not just legal requirements or moral choices, but also economically advantageous strategies. They prevent the need for heavy regulatory costs and help to maintain the essential public trust in the economic system. In this part of our exploration of corporate governance and corporate ethics, we will highlight some of the most infamous corporate scandals in recent history and discuss the implications for corporate governance. The list of companies like Enron, WorldCom, Rite Aid, HealthSouth, and Global Crossing, among others, serves as a sobering reminder of the consequences of poor corporate governance and unethical accounting practices. Each of these companies was involved in accounting scandals that not only led to their downfall, but also had far-reaching effects on the economy and the public's trust in corporations. For instance, Enron's scandal, driven by fraudulent accounting practices, not only bankrupted the company, but also shattered the retirement savings of thousands of employees. It is a stark example of the destructive potential of unethical corporate behavior. Furthermore, we touch upon the issue of misleading research reports by major financial institutions such as Citicorp and Merrill Lynch. These instances raise questions about the integrity of financial analysis and the potential conflicts of interest when research may be influenced by other business relationships or investment banking institutions. Lastly, we address the critical role of auditors in the financial reporting process. Using the case of Arthur Andersen and Enron, we explore whether auditors should act as strict watchdogs over financial reporting or as consultants helping firms navigate complex accounting rules. This leads us to a broader debate about the independence of auditors and their ability to withstand pressure from their clients. These cases underscore the importance of ethical conduct in corporate governance and the crucial role of transparency and accountability. They serve as cautionary tales that demonstrate the necessity for vigilant regulatory oversight, strong internal controls, and a culture of ethics within organizations. In light of the devastating corporate scandals we previously discussed, we now turn to a significant legislative response, the Sarbanes-Oxley Act of 2002, often referred to simply as SOX. This act was a transformative moment in the history of corporate governance and ethics, fundamentally reforming corporate accountability. SOX brought about several key changes. First, it increased the number of independent directors on company boards. This was a direct attempt to strengthen internal checks and balances, reducing the risk of conflicts of interest and increasing the oversight capabilities within companies. Secondly, the Act requires the Chief Financial Officer, or CFO, to personally verify the accuracy and completeness of financial statements. This clause addresses the issue of accountability head-on, ensuring that senior financial officers are not just responsible, but are personally liable for the veracity of their company's financial disclosures. The third significant change introduced by SOX was the creation of the Public Company Accounting Oversight Board, PCAOB, which provided a new layer of oversight for the accounting and audit industry. This board was tasked with enforcing auditing standards, inspecting accounting firms, and imposing disciplinary actions when necessary. Lastly, Sarbanes-Oxley charged the board of directors with maintaining a culture of high ethical standards. This provision underscores the importance of ethics at the highest level of corporate governance, sending a clear message that ethical behavior is not optional, but a core responsibility of corporate leadership. These reforms were not merely bureaucratic changes, but also a cultural shift towards greater transparency and responsibility in the corporate world. The Act claims to restore investor confidence, deter and punish corporate and accounting fraud and corruption, and protect the interests of workers and shareholders. In summary, the Sarbanes-Oxley Act marked a pivotal moment in corporate governance, reshaping the landscape to foster an environment where ethical conduct and accountability are paramount. Next, we explore asset allocation as a key part of the investment process. Asset allocation may be defined as a strategy for investing that focuses on distributing a portfolio's assets in a way that balances potential risk and returns so that they align with the investor's objectives. Specifically, asset allocation involves strategically deciding the proportion of a portfolio's funds to be invested across various asset classes. For example, a basic allocation could look something like 60% in stocks, 30% in bonds, 6% in alternative assets, and 4% in money market or cash securities. This allocation reflects a strategic approach tailored to meet specific investment goals and risk tolerance. When we discuss stocks, which make up 60% of this sample portfolio, we're focusing on equity investments that offer growth potential but come with higher risk. The 30% allocated to bonds represents investment in debt instruments that generally offer lower risk and fixed income returns. Alternative assets making up 6% could include investments such as real estate, commodities, or hedge funds, which may provide diversification benefits and non-correlated returns. Finally, the 4% in money market securities suggests a portion reserved for liquidity and safety, often seen as the least risky assets. Beyond these percentage allocations, an essential part of the process is security selection and analysis. This means choosing specific investments within each asset class based on a thorough analysis to ensure they align with the investor's objectives and the overall portfolio strategy. It's important to emphasize that the asset allocation decision is foundational to the potential returns of the portfolio. While individual security selection and market timing may also impact performance, numerous studies have shown that the decision on how to allocate investments across different asset classes has the most significant influence on long-term portfolio outcomes. You should specifically look for the writings of Ibbotson and Kaplan, in particular, an article from the year 2000 entitled, "Does Asset Allocation Policy Explain 40, 90, or 100% Performance?" You can find it in the Financial Analyst's Journal, either in the Keiser library or possibly if you do a search using Google Scholar. Next, let's consider the fundamental concept that underlies much of investment theory, the risk-return trade-off. The core idea is that assets with higher expected returns come with a higher degree of risk. Let's consider stocks. Historically, stocks have provided an average annual return of between 10 and 12%. However, this return is not without volatility. In 1931, the stock market experienced its minimum annual return with a loss of 46%. On the flip side, the maximum return reached 55% in 1933. It's crucial to communicate to investors that stocks can be volatile, and it's reasonable to expect that a stock portfolio might lose money approximately 1 out of every 4 years. In contrast, bonds generally exhibit much less volatility compared to stocks. They offer a lower average rate of return, typically under 6%, and historically they have not lost more than 13% of their value in any 1 year. This reduced volatility reflects the lower risk associated with bonds, which is also mirrored in their lower expected returns. This data exemplifies the risk-return trade-off. Investors seeking higher returns must be willing to accept greater risk, and conversely, those who desire stability and less risk must accept lower returns. It's an equilibrium shaped by the competitive nature of the markets, where every investment's risk level is compensated by a commensurate level of expected return. Understanding this trade-off is essential for investors when constructing a diversified portfolio that aligns with their individual risk tolerance and investment goals. In this section, we contrast two fundamental investment strategies, active and passive management. The approach an investor or fund manager takes can significantly influence the outcome of an investment portfolio. Active management operates under the premise that markets are inefficient to some degree. Active managers aim to exploit these inefficiencies by identifying and investing in undervalued securities, those they believe the market has mispriced. They utilize intensive research, market forecasts, and their own judgment and experience in an attempt to outperform the market. Additionally, active managers may attempt to time the market, making tactical buys or sells to take advantage of market movements. In contrast, passive management is based on the efficient market hypothesis, which assumes that at any given time, asset prices fully reflect all available information. Proponents of passive management therefore believe that it is not possible to consistently outperform the market by identifying mispriced securities or timing market movements. Instead, passive management involves choosing a diversified portfolio, often mirroring the composition of a market index and holding it over a long period of time without attempting to make tactical trades. Passive management aims to minimize transaction costs and perform in line with the market benchmarks. This strategy is often implemented through index funds or exchange-traded funds, ETFs, that track a specific market index. To summarize, Active management seeks to outperform the market through selection and timing, while passive management seeks to match the market's performance through a diversified and steady approach. Both strategies have their merits and can be used effectively depending on an investor's goals, risk tolerance, and investment time horizon. In the investment arena, we have distinct entities that play critical roles. Understanding these players is essential for grasping the dynamics of how capital markets operate. First, we have business firms, which are generally net borrowers. These companies typically require capital to fund operations, expand their businesses, and invest in new projects. They access capital by issuing stocks or bonds or by taking out loans. Households are traditionally net savers. Individuals and families save money by depositing funds into savings accounts or investing in securities like stocks and bonds, often for goals like retirement or education. Governments, on the other hand, can act as both borrowers and savers. They borrow by issuing government securities to fund various projects or to cover fiscal deficits. Sometimes, when running a surplus, they can become savers in the economy. At the core of this investment network are the financial intermediaries. These are the connectors of borrowers and lenders. They play a pivotal role in the financial system. Commercial banks are one primary example. Their traditional business model involves accepting deposits and using those to make loans. Banks are therefore central to the flow of money in the economy, affecting both liquidity and credit availability. Investment companies, such as mutual funds, collect funds from individuals and invest those in a diversified portfolio of assets. They allow individuals to gain exposure to a broader range of assets than they might be able to manage on their own. Insurance companies collect premiums and invest them in a range of financial instruments, with the dual purpose of generating returns and ensuring they can cover policyholder claims. Pension funds gather and invest workers' retirement savings. They have a long-term investment horizon and are significant players in the global financial markets, often holding large portfolios of stocks and bonds. Lastly, hedge funds are investment funds that employ diverse strategies to generate returns for their investors. They are known for their flexibility in investment choices and may use leverage and derivatives to amplify their investing strategies. Each of these players interacts within the financial markets with different objectives and methods. Together, they create an ecosystem that enables the flow of capital, driving economic growth and wealth creation. Investment banks play a critical role in the financial markets, acting as a bridge between issuers of securities and the investing public. These institutions specialize in primary market transactions, which involve the initial creation and sale of securities. In the primary market, investment banks are instrumental. They facilitate the issuance of new securities, such as stocks and bonds, by corporations and governments. A key service they provide is underwriting, where the investment bank buys securities from the issuer and then sells them to investors, often taking on the risk of the sale. The primary market serves as the birthplace of securities, where capital is raised for entities looking to fund new projects or expand operations. The investment banks not only sell these securities, but also provide advice, help set the initial prices, and create the market for the securities through their networks and expertise. Once the securities are issued in the primary market, they move to the secondary market. This is the venue where pre-existing securities are traded among investors. While investment banks may also facilitate transactions in the secondary market, it is primarily characterized by exchanges and over-the-counter trading where investors buy and sell securities from one another. This secondary market provides liquidity, allowing investors to buy and sell securities post-issuance. This market is crucial as it determines the real-time pricing of securities and allows investors to exit or enter positions. In essence, investment banks are pivotal in supporting the flow of capital within the economy, aiding in the distribution of financial assets, and assisting in the establishment of market prices through their activities in the primary and secondary markets. Next up, a glimpse into the historical evolution of the investment banking sector and its regulatory landscape. From 1933 to 1999, a legal divide existed between commercial and investment banking activities. This separation was mandated by the Glass-Steagall Act, which was enacted during the Great Depression to reduce the risk within the banking system by limiting the securities activities and affiliations within commercial banks. In 1999, this long-standing separation was dismantled with the repeal of Glass-Steagall provisions by the Gramm-Leach-Bliley Act, or GLB. This legislative change allowed commercial banks, investment banks, and insurance companies to consolidate and provide a broader array of services. Consequently, large investment banks, often referred to simply as Wall Street, operated independently and expanded their revenue streams. However, this expansion did not come without its challenges. The repeal allowed commercial banks to venture into the investment banking domain, thereby intensifying competition. This led to pressure on the profit margins of dedicated investment banks as they now faced competitors that had extensive customer bases and deep capital reserves due to their commercial banking operations. The financial crisis of 2008 marked a significant turning point for the investment banking industry. Several major investment banks faced catastrophic losses due to their exposures to collapsed mortgage markets. In response, some of these banks either went bankrupt or were forced to reorganize as commercial banks to avail themselves of federal rescue funds. Others were acquired by larger commercial banks, leading to a consolidation in the industry. The events of 2008 underscore the interdependence of financial services and the profound impact that market conditions and regulatory changes can have on the structure and stability of financial institutions. In continuing our historical review of investment banking, we encounter a strategic pivot by several investment banks during the 2008 financial crisis. Faced with a severe liquidity crunch and with the aim of stabilizing their operations, some investment banks chose to convert into commercial banks. This transformation allowed them to access deposit funding, which is generally more stable than other types of short-term wholesale funding. Moreover, it opened doors for these institutions to receive government assistance, which was crucial for survival during the crisis. As a consequence of these conversions, all the major investment banks are now subject to the more stringent regulatory framework that governs commercial banks. This shift has wide-reaching implications for the industry. For instance, these former investment banks now face greater scrutiny in their risk-taking activities. They are required to maintain higher capital and liquidity levels, which can reduce their ability to leverage, potentially limiting returns. This shift could constrain the aggressive strategies that were a hallmark of some investment banks pre-crisis. Regarding innovation and capital issuance, these changes could have a dampening effect. The stricter oversight and compliance requirements might inhibit the ability of these banks to engage in certain complex transactions and to innovate in areas like structured finance. Conversely, these changes could lead to more stable financial institutions, less prone to the kind of risks that contributed to the financial crisis. In theory, the rigorous commercial bank regulations could result in a more prudent allocation of capital, fostering a more resilient banking system. The question posed on this slide invites us to consider the trade-offs between financial stability and the dynamism of capital markets. How do we balance the need for innovation and capital formation against the need for stability and protection against systemic risk? This is a question that continues to shape regulatory policies and the strategic decisions of financial institutions. This concludes this live chat segment. If you are participating in the live event, we have some time now for Q&A. If you are watching the recorded version, please contact me via email, text, or voice with any questions. Until next time, see you online.